Hey, everybody. Good evening, good day, wherever you are in the world, and welcome. The three amigos are here with you, and we're really excited to talk to you. Take your questions, talk about some current events. Interest rates are up, the economy is changing, the Bank of Japan is getting a little weird on us, and George is not drinking booze there, is he?
No, it's water.
That's water. Okay, good. Anyway, welcome everybody. It's good to have you. So we're going to jump into a bunch of topics. Maybe I'll start with George. You got a lot going on lately, buddy. What's happening?
Yeah, so the first thing that I wanted to bring to the attention of your audience, because I know a lot of them probably have fixed rate debt or a fixed rate mortgage, is make sure you don't give that up. Make sure you don't give that up. And my rationale may sound a bit odd. It's not because the government is printing money and therefore we'll have inflation, and the money supply is going to go up and therefore we're going to have inflation, which is going to reduce the burden of your debt and you're going to be paying it back with cheaper dollars. And how many, I mean, just as a show of hands out there, you know, how, including Jason and Kenny, how many of you have heard this, that the government is printing money and that the money supply is going to increase, and if the money supply increases, then we have to have an equal amount of consumer price inflation. Like Milton Friedman says,
Yep.
inflation is always and everywhere a monetary phenomenon.
Yeah.
Right?
Yeah.
Well, what I want to do is I want to try to educate your audience and show them that this is absolutely false. And
all right, fire away.
But what I want to do and what I'll conclude with is showing them as to how is why the decade of the 2020s will most likely be even more inflationary than they had assumed coming into this conversation. Even though I think that in 2023 we could get some disinflation and some maybe even some deflation, depending on how bad the market gets. But let's start by going over a chart here that I think is really going to surprise you guys. I'm actually really excited to show you guys this.
Let me put that into the screen here. There you go.
So just let me know if you guys can you see the chart?
Yeah.
Okay, so yeah, so this black line represents M2 money growth, M2 money supply. The blue line represents nominal GDP, and the red line represents consumer price inflation. So let's look at this. I mean, between this time frame, we had the money supply, as measured by M2, increased by 423%. 423%. And this is from 88 to 2019. So, as you would assume, money or inflation is always and everywhere a monetary phenomenon. We had 120% CPI. In other words, prices went up by 120% during this time frame, and nominal GDP went up by 327%. And again, that's not adjusted for inflation. So you say, well, George, there you go. Look, the money supply increase, all this fiat currency, which is theft, it's stealing purchasing power away from everyone. And it's all a result of the Fed and the government just printing money. Money printer go burr, right? All right. Let's go back, exact same time frame, about 30 years, from 1867 to 1899. Now, Jason, can you see this black line? How much did the M2 money supply increase back then?
It is very small on the screen, but a lot.
Okay, so I'll tell you, 400%.
Yeah.
So basically, the exact same as.
Oh, I got a bigger screen now.
That we just saw, but this time we did not see, call it 100 and whatever it was percent CPI growth. We saw negative 45%. Negative. That means from 1867, call it, to 1899, prices went down by almost 50%, when the M2 money supply went up by an equivalent amount of 400%. So if there is this one-to-one relationship or a fixed relationship, where if the amount of currency units in the real economy, let's say, goes up by 5, And therefore, the inflation units will go up by 1. Therefore, if we take it to 10, then the inflation units will go up by 2, right? We can prove just with these two charts that that is completely false. It's not always true. In fact, it's very rarely true. And I could show you that throughout this entire timeline. If we went to the 1930s, in fact, let's do that. We can go 1930s to 1930 to 1960. That that rough 30-year time frame. And what do we have here? We have money supply growth, 400%. We have CPI, 75. Again, completely different. You got the exact same M2 money supply growth, but 3 completely different levels of inflation.
Okay, so what is your thesis then? Why is it different with M2 growing and inflation responding sometimes and not on others? Why?
Because there has to be another variable. That's the punchline, right?
Yeah.
So what is the variable? What you learn when you study the data is that consumer price inflation isn't necessarily a result of an increase in M2. It's a result of an increase in M2 above and beyond real GDP growth. So if you've got an increase of 400%, but you've got an increase of real GDP by 300%, which is what we had in the late 1800s, you see a price decrease of almost 50%. But if we fast forward to this time frame as an example, we see an increase of roughly 400% M2, but we only see an increase in real GDP of about 200%. Therefore,
and what years are you on now? Were you talking about that?
Roughly 1930 to 1960.
Okay.
That 1961. So roughly that 30-year time frame. So then you would expect, since GDP, real GDP growth was lower, but we still had the same M2 increase, you would expect CPI to be higher, which it was. And you can go through any time frame you want as far as this 30-year time frame, and you'll see the exact same results. So then the question becomes, well, how do we figure out what real GDP growth is going to be? And that's where we go to this next chart.
Okay, so before you leave that, though, I think one of the big factors here, George, is that M2 doesn't count credit supply. It's, you know, and you see the growth of credit that really took off in the 60s.
How does M2 not account for credit?
Well, it's checking accounts and cash.
What is credit?
Well, credit is ability to borrow.
Right, but you borrow what?
Well, you borrow money, but the money
dollars.
doesn't. Well, fair enough, but the money
goes into
doesn't.
Someone's checking account.
Yeah, sort of.
Not sort of. If I lend you $500,000 as a bank, that goes directly into your checking account. Let's say you use that money to buy a house.
Yeah,
that goes into the seller's checking account or their savings or a money market fund.
The way that transfers through the economy is there's a cut, you know, at every level of that exchange, and that's why velocity is important. But okay, go ahead.
How is there a cut?
Well, every time it changes hands, the velocity increases, right? So there's more velocity of money.
M2 money supply.
Right. Yeah.
That's credit.
Yeah.
So the way you get to M2 money supply, the majority of it,
you know what I'm curious about?
Banks extending credit and loaning the dollars into existence.
Yeah, you know, well, we all know money's lent into existence, but I'm curious, what do you think? Why do you think they got rid of M3 around 2006 or 7? I remember when that happened. You know, what's your thought on that? I've never asked you.
I don't know why they did it specifically. It was definitely a much more complete picture.
I agree.
Maybe not the currency units in circulation, but overall purchasing power.
Right.
So now I think what you have to do is you have to look at M2 in terms of higher velocity money and lower velocity money, meaning that if you look at M2, you've got to look at how much of that is owned by non-bank entities. And then you've got to, or non-financial entities might be a better way of saying that. And then you've got to look at how much is occupied, what percentage is occupied by financial entities, and that would be low velocity money, right? But still, regardless, that combo, that aggregate total has to be lent into existence. So that would definitely show up as far as credit on M2 money supply.
Yeah. So I think there's another component of this, and it's a psychological component, and that is the general wealth effect. Because in the past, I mean, decades ago, when people had equity in their home or other assets, they didn't view that as an ATM. That psychology started to occur really in the 1980s. And so, even if you don't borrow the money, but the fact that you have the asset and you can borrow that money changes your psychology. It changes your wealth effect. It does it on a whole society-wide basis. It makes you feel richer. In the past, when people had equity in their home, they thought, oh, well, Mildred, we're just paying off our mortgage and, doing the right thing by paying off our debts. But nowadays people think, oh, I got this, I can always just borrow against it, right? Everything's an ATM nowadays, even an auto, even a paid off car, just go get an auto title loan and refinance your car. So it's kind of a different psychology.
Yes and no. If we look at M2 money supply growth, it's going to be a lot lower from 1991 to 2020 than it would be from 1960 to 1990.
Yeah,
that's for sure. But still, we're looking at M2 money supply versus real GDP growth.
Yeah.
And that's what's going to give us that equation.
George, I have one question. So this is interesting. In the last chart, money supply was above GDP. This one, it's obviously below. Is that where we're heading with this? And is that the relationship to watch?
So let me get to this next chart here. So during this first time sequence, which you can see right here, you see that government spending as a percentage of GDP is very low, under 10%. And then you can see 1930, 1960, it expands just in a mind-boggling way. It expands from 15% to call it 30. During this time frame, real GDP growth went down from 300% to 200%. So what you can see is a direct correlation between the amount of government spending, or actually an inverse correlation between the amount of government spending as a percentage of GDP and real GDP growth. So the punchline here is, if you analyze this as much as I have, you come to the conclusion, and there's no certainties, only probabilities, but the probability is very, very high that as we continue, or if you believe we are going to continue to increase government spending as a percentage of GDP, we will also decrease real GDP growth. And if we have an increase or a sustained level of M2 money supply growth, then we will inevitably get inflation over the long run. But it's not exclusively because of M2 money supply. It's more so a result of government spending as a percentage of GDP.
So what's the prescription in that?
The prescription is, if you're someone who believes that government spending is going to continue to increase over this decade, then real GDP growth will go down. The standard of living will go down significantly.
Yeah.
Because right now we're at 94%. Over the last 30 years, call it from 90 to 2020, real GDP growth was only 94%. Why? Because government spending is so high. So if let's just extrapolate this out another 30 years, assuming that someone just got a 30-year mortgage today, that means that over the next 30 years, there's a very high probability that real GDP growth could be zero compounded over the next 30 years. Now, I can assure you that money supply growth will increase more than zero, far more than zero.
I agree with you there.
And therefore, that would produce significant consumer price inflation. Significant consumer price inflation.
So, George, a lot of people look at, what's happened in Japan over the years. I'm sure you've thought this through. So, they have a central bank, they've been printing, and their GDP is high over that period. When I went there, I think it was 220 when I was in Tokyo. So how does, what's the difference here?
Well, see, that's a great question. Number one would be M2. So you've got to look at the increase in M2. So Kenny, let's just assume for a moment that we had a stagnant economy. and that it didn't grow at all, right? And so that real GDP growth was pretty much zero for 30 years straight. Well, if you didn't really increase M2 money supply, or if you only increased it by a certain amount, you might not see consumer price inflation. And I think this is kind of the story of Japan. But there's a lot of variables there. That's a great question. And it also goes back to
demographics.
Demographics, their savings rate, and the fact that they are a massive exporter, that they have huge trade surpluses. And this creates a lot of additional demand for Japanese yen. And also, when the Japanese get that yen, they usually take that and invest it outside of the country. And then that's why they're such a huge net creditor, because they own so many U.S. assets.
Right. That is true.
So there's a lot of variables there. And
does the declining population have anything to do? Because the population is declining in Japan and in the U.S. Like if you look at the math, I mean at the rate, I guess.
Yeah, so the declining population is going to definitely add to the reduction in real GDP, and is definitely going to add to, or most likely add to, government spending as a percentage of GDP. The declining population is interesting, though, because you've got so much debt in the system that if the amount of debt decreases because you don't have more of it being issued and you have a lot more of it being paid back, then you've got a counterbalance to the government trying, through the help of the Fed, trying to create more money supply, which I think they'll only be able to do with a central bank digital currency. So you've got the Federal Reserve taking their bank reserves, turning them into legal tender, trying to inject them into the economy to increase M2 money supply, so they don't get this dreaded deflation that they're so scared of. While at the same time, you've got that demographic issue. So more people are paying off loans than are receiving new loans. And therefore, that in and of itself would bring M2 money supply down. So you've got these two contributing factors that are kind of at play at the same time.
So, by the way, folks, if you have any questions for George or Ken or myself, put them, just comment down below in the chat, and we will get to your questions. George, I'm curious, why would Japan's it's good that Japan's a net exporter and, people want their products. Why would that contribute to the lost 2 decades? Why is that deflationary?
I'm referring more specifically to the yen.
Okay.
So, why hasn't the yen blown up? Or why haven't we seen this massive increase in their CPI? We're just now seeing that. In fact, it went up to 3%, which is why they're kind of abandoning their 25 basis point yield curve control on their 10-year JGB, right? But the reason they've been able to export, if you will, a lot of that inflation is because there's so much demand for yen. Because what happens is if you've got a Japanese product, right, and that's being exported, then what's going to happen is you're creating more demand for yen.
Yeah.
Right. Just like, as an example, we are a net importer, so we have a massive trade surplus.
Right.
So, excuse me, a trade deficit. So what happens with our trade deficit is we import a lot of stuff and we export a lot of dollars.
Yeah.
Or they're doing the opposite.
Right.
Interesting. What do you have you been watching this thing with Putin on talking about the oil? I'm sure you have the petrodollar and taking gold for oil and he's trying to. What do you? I've been wanting to ask you this question and I didn't want to wait till the collective event in February. So what do you see there? Because it says that obviously there's a ton of articles on this, but it says that gold could go from 1,800 to 3,600 with that
Zoltan Pozar.
Yeah. So
it's actually a pretty interesting thought experiment. So his concept in his paper was that Biden has to refill the SPR, which is the Strategic Petroleum Reserve, because he knows that there's tumultuous times maybe ahead with Russia, unfortunately, and that's one thing that you don't want to be at risk of losing, which is as far as your source of energy, if it comes down to that. So, but the problem there is they, for political reasons, they don't want to buy it at more than $60 because they've got this price cap and all these things. So Zoltan's idea is that maybe, just maybe, and this would have to be done kind of behind the scenes, and they could do it because the United States could just export or import the oil from like India or something like that, and then India could just buy it from Russia. So we're not importing it directly from Russia. So then, of course, the politicians wouldn't like that because they've got to do their virtue signaling. So but the bottom line is they're getting Russian oil to fill up this SPR, but they want to get it at that good price, right? Under the market rate. Right now, it's called 75 a barrel. So his idea is that Putin comes out and says, okay, well, I'll sell it to you at, instead of paying me in dollars, I'll sell it to you for gold. So 1 barrel will be 1 gram of gold. And if you actually do the math per ounce, that kind of equals what the rate would be if I'd have to do the math there. But you see, but 1 gram, I think, equaled about $60, right around there.
Yeah, well, it's 1/28. So
yeah, so it was right around $60. It was right around what Biden wanted to pay based on this price cap. So he said that now to incentivize the deal to buy from Russia and also to help out Russia, and I'll explain this in a moment, Putin might say, okay, well, actually, we'll sweeten the deal. Instead of 1 barrel for 1 gram, we'll give you 2 barrels for 1 gram. So then what this does is this incentivizes the United States to go out and pay up to $120 per gram.
Right.
You see? So this effectively would, on the open market, would double the price from $60 a gram up to $120 a gram. Because if they're buying that 1 gram of gold for under $120, they're getting a price break because they would have been willing to pay $120 for the 2 barrels of oil to begin with.
Yeah, and if the gold is $1,700 an ounce, it's $60 a gram. Exactly.
Yeah, so then that doubles and that goes up to 3,400 or roughly 3,600. I think there's a couple with a troy ounce. It gets a little weird as far as the math. But so then why would Putin do this, right? Because you got to look at his gold reserves. Since the last time he got sanctioned in 2014, he's been buying gold hand over fist. And he bought gold all the way up until like 2020, and then it kind of flatlined. And then sure enough, a year later, 2 years later, he goes into Ukraine, and then he starts, pulling all of his shenanigans. And so he's got a massive, relatively speaking. Now, we as the United States have more and whatnot, but relative to what he had, he's got a huge supply of gold. So this would basically double the value of his gold, which is, when you think about it, it's one of the only assets that has no counterparty risk, which is what he's extremely concerned about right now. Why? Because the United States sanctioned all of his dollar assets,
right,
from his central bank.
For Putin, the dollar's got huge counterparty risk.
Well, now for everybody it does.
Yeah. Well, yeah.
Everybody it does.
Especially,
and that's one of the reasons why you see these BRIC countries, Saudi Arabia, doing transactions and settling for things like oil outside of the United States dollar. See, so that was Zoltan's kind of thought experiment, and he said that basically he's not saying that this is definitely going to happen. It's not really a prediction, but he said the probabilities are definitely a lot higher than 0.
Want to take a couple of these comments and questions here?
Yeah, here's a couple good questions there. Let's there's a couple good ones
for you. Yeah. So, why didn't the Treasury or government refinance the national debt when rates were 0? Everybody else refinanced their house.
They refied a lot of it. I mean, I think they refied as much short-term stuff as they could, because now they're, I don't know what it is. Well, I shouldn't say now, but prior to raising rates, for the entire, was 25 trillion they had, the average interest rate they were paying was about 2%. So I think that's, there's balance sheet management there. But I guess my short answer would be that I think they tried to do that with as much as they felt comfortable doing that with. Because you got to remember, if they refied it at the lower rates, they would have had to basically take all of their balance sheet and turn that into very, very, very short-term debt, where they would be massively liable or massively susceptible to future rate hike increases.
Okay.
Because basically what you're doing, you're changing a 30-year fixed rate mortgage for a 1-year adjustable.
Right. Yeah. Or a HELOC. Yeah, exactly. So I got to post one of the most important questions of the night, but I think the viewer is going to be disappointed with the answer because it's nothing big. But by the way, folks, have any comments or questions, please post them and we'll get to them. And also, please hit the like button for us too. Here's the important question.
Just water. Cool picture. Is that Jesse Ventura and Alex Jones?
Nothing exotic here. Yeah.
Oh, just water for me.
Yeah. We're being healthy tonight, folks.
George, I had a question about that inverted yield curve. You know, I know there's been a lot of talk about it, but the rates for the 2-year treasury are above the 10-year, right? So like, what are you seeing around all that? Because that's something that, you know, obviously, I guess it's been 2 months now. So where do you see all that heading?
Well, Kenny, first of all, let's be clear. The lowest rate that what is supposed to be the floor on all interest rates, at least overnight rates set by the Fed, is something called reverse repo. So that is the way the Fed manages setting a floor on interest rates, meaning that's the lowest interest rate they want to see throughout the economy, at least with the overnight rate, which I think if you ask them, they'd say that that's what we'd like to see as far as a baseline rate throughout the entire yield curve. So that's just the overnight rate to park your money at the Fed. Right now, that's about 4.3%. All right. So it's not just the fact that the 10-year is under the 2-year. It's the fact that the 10-year and the 30-year it's under reverse repo.
That's insane.
That's nuts.
Yeah.
Which is the lowest overnight rate set by the Fed, and theoretically is supposed to ideally set a floor on interest rates throughout the entire economy.
So just in layman's terms, that means that people are more bullish on the short term than the long term, right?
No. Well, it depends on how you're defining bullish. Are you defining bullish on as far as interest rates going down, therefore the price of the treasuries going up?
Yeah.
That would be at the long end. Because what that bet is implying is that the Fed is going to pivot sooner than later. And when they pivot, because of recession, they see interest rates coming down. So if you can buy a 30-year treasury, let's say at 3.5%, and that interest rate goes down to, let's say, 1%, that's a significant capital gain. So so that's what these huge hedge funds and big financial institutions around the globe are not only betting on, but then they're hedging as well. You see, most people don't understand that the treasuries are used in a variety of ways. It's not just the average Joe buying a treasury to collect a coupon for the next 10 years. In fact, I would argue that's probably the least demand for treasuries. Most of it, especially at the front end of the curve, is the demand comes from these financial institutions and banks in the Eurodollar market really managing their balance sheet. And then also really hedging when you get to an environment where they believe there's a high probability that we go into a recession. So you've got your long exposure. It'd be just like you, Kenny. Let's just say that you felt as though some of your apartment complexes were in more cyclical markets. Let's say you had apartment complexes in LA, and York, and
Midland, Texas.
Yeah, wherever the big cyclical markets are that could get hit pretty hard with a recession. So what do? Well, you take some of the cash on your balance sheet and you go out there and buy the 10-year. You buy the 30-year. Because if we do have that recession, which is going to potentially where the asset side of your balance sheet, as far as those rental properties are going to take a hit, then you offset that hit by the capital gain that you would receive by buying the long end of the curve. So these are the dynamics that people really have to think about. And this is why the signals that the yield curve gives you are so powerful.
Yep. Very important stuff. And that's why it signals a recession when it gets inverted. Okay. So let's see here.
I think one of the things also is, we just went through 6 rate increases, right, at the Fed funds rate at least, and everybody's like, "What's going to happen in 2023?" And I think we should probably get at least into that topic.
Yeah. So in my opinion, I think you're going to see the Fed raise rates probably to around 4.75%, because that's the high water mark in the 2-year. And that's historically kind of where they've gone. Now, from there, I think they'll pause and or pivot. Now, is that a result of a soft landing and just the CPI down to a more manageable level? Or is that a result of a hard landing, where what the yield curve is predicting is actually a very significant recession, or possibly even an economic crisis like we saw during the GFC, or just prior to COVID and all the lockdowns and whatnot? So I think, someone has to determine the probabilities of whether they think we're going to get that soft landing, or whether they think we're going to get that hard landing. And if we get a soft landing, then I could see the Fed just pausing and kind of just waiting to see how it plays out. And in that environment, if they maybe notch down rates a little bit, then you could see mortgage rates start to ease off a little bit. And that could be an opportunity for people to maybe refi or take out debt at a cheaper rate than they could get it right now. The problem is, if we go into a hard landing and then interest rates go right back down to zero, that could mean that money's cheap, but it's tight, right? And I hate to say this, but it's just the reality of the situation. For the Kenny McElroys of the world, you could probably get debt that cheap. For the George Gammons of the world, it ain't going to happen. It ain't going to happen. And so that's why you can go into an environment where money's cheap,
but tight.
Yeah.
So by the way, folks, an index for that I've talked about on the show a lot is the MCAI, the Mortgage Credit Availability Index. Look it up, and then you can get what George is talking about, which is the idea that interest rates could be low, but the money's just very hard to get because the lenders are very tight with it. And we got a super chat here, guys.
Well, here's a question I think pretty much in line with what we're talking about. There's a single family deal lined up that would rent $2,000 a month for Section 8 for $90K.
Yeah.
Okay. But worried about liquidity crisis, and it's a cash deal, wouldn't get a loan until stable.
Yeah.
So I mean, I'd be more worried about the tenants than I would the liquidity crisis on that deal.
The thing I'm wondering about that deal, AC, B&B, is that's such a cheap property and the income is so high. Number one, is it a single family, or is that like a little duplex?
Yeah, no, single family. It says single family.
Oh, yes. Thank you. Okay. But is it not financeable today because the property's in really bad condition? Is that what's going on there? Right. Those are some questions to ask. And Section 8, a lot of people sort of love to hate it, but a lot of people do really well with Section 8. And remember, it varies city to city. Some Section 8 departments are a nightmare to deal with. They're the government, right? And some are easier to deal with. And, my mom had a bunch of Section 8 rentals when I was a kid growing up. And I used to say she complained all the way to the bank.
Yeah. Is there a minimum loan amount that you can refi, though?
Well, you can get a $90,000 loan.
You could?
Yeah.
Too low?
It'll like $50,000 at least, recently might be the limit. Oh, here he's got a follow on. Okay, another super chat here. It needs work, but Section 8 works. Yeah, I wonder. I mean, can't you get financing on it though? Try to get financing on it if you can.
And would it be true that at least at the community banks there may be a little less liquidity in a C neighborhood than an A neighborhood, or is that not true?
I think that's true. I mean, a community bank would be more likely to do the loan
on an A neighborhood.
On any neighborhood in their local area. You know.
Okay. So so there's not going to be less liquidity in a C neighborhood than an A neighborhood.
Oh no, there would be less liquidity. No, that
Okay.
concept is definitely true because, you know, the houses in really bad condition, the lenders don't want to finance them. Okay.
Yeah.
But don't forget, this is Section 8. So Section 8, if 2,000 is the number from Section 8, that's the number, right?
Then take it. And if Section 8 is willing to approve it for Section 8, then it can't be that bad. So,
Right.
Yeah.
Yeah. So
Because
you don't have
Section
to
8's
worry
picky, you know,
about
they require
if they have
window
jobs.
screens and all kinds of crap. Yeah. Go ahead, Kenny. Sorry.
No, I'm saying, you know, the liquidity or the tenant having a job is a secondary issue, you know, because you're getting that Section 8 money, right?
Right. Yeah. And they stay a long time because they're on the dole, you know.
And so he says, I'm spoiled with a bunch of loans at 3%, so I don't want to get I guess he borrowed a lot at 3%, so now that the rates are a lot higher, he's like that sticker shock almost.
Yeah. Well,
that's what you started with, though, George. You said if you have a loan like this, it's gold, right? Moving into the
Yeah,
period of
that's
time.
my whole point is if you've got that awesome cash flowing property right now with 30-year fixed rate debt, remember that's an asset on the balance sheet, in my opinion.
It is.
Yeah.
In fact, in my world, that's one of the that's actually what people are looking for. We're actually trying to step into other people's debt.
And Kenny, how hard, assuming those loans isn't that difficult, like the due on sale problem really exists in the single family market, but it doesn't exist in the apartment.
Good point. Yeah, these are agency loans, right? Freddie and Fannie, and they're assumable.
Yeah. I wish we had that in residential, buddy.
I know.
That would be because think about that, guys. You know, the due on sale clause is kind of like rent control. It makes a market stagnant. You know, people don't want to move. They can't release their properties. One way they could really stimulate the economy is just suspend the due on sale clause, because then people would trade properties and they wouldn't hang on to those cheap mortgages because another person could come in and buy the property and assume the mortgage, right? That'd be interesting.
Yeah. So what are you guys' thoughts on I've seen a lot of charts on Twitter where they talk about, they imply that nominal prices are going down in markets like San Francisco, let's say. But then the chart they show, I'm a little skeptical because I can see how nominal prices would be coming down. But what they show to prove that point is just the average sale coming down. I'm like, well, that doesn't necessarily mean that the prices are coming down. That just means that the average sale is coming down. Maybe just more people are buying at the low end of the market.
Now, do you mean sales volume or sales prices?
No, sales price. So what they'll do is they'll say, oh, look at the prices are coming down in, let's say, San Francisco. And they'll show that the average sale went from, let's say, $1 million down to 800,000 as proof that there's been a 20% drop in the overall market. And I'm like, well, maybe it's just more people buying at the low end.
Yeah, right.
So or buying it in a different market. Yeah.
What's that, Kenny?
Well, also, you know, if the $1 million homes or the $1 million homes are clustered in one area and the 800 are somewhere else, you know, there might already be a pricing disparity. So it's not a true number.
So how much weight do you guys put on those charts? And then what would be maybe a more accurate reflection as to, or what data points, what metrics would be a more accurate reflection as to what the prices were actually doing, like apples to apples?
Well, you got to have the same house. It's like in the stock market when they talk about same store sales, that's a very valid metric. Because if you take Best Buy, for example, and you're looking at their stock, and you know Best Buy is opening, say the economy's booming, and Best Buy is opening new stores, for example, right? Well, then the overall revenue is going to go up because you're just got more stores, right? More the overall sales, not necessarily revenue, because there's capex. But if you look at same store sales and you look at same house trading, the problem is they don't trade that often. So it's difficult.
I'll give you one example in Scottsdale, George. So, you know, Danielle, my wife, she's like, she loves this business. So she's been looking at $500,000 houses in Scottsdale, which are hard to find because they rent for about $4,000. So, you know, simple math, right? Those are her two metrics. So she first found a property that was listed at $699 that she liked because non-HOA, big lot, built in the 70s, early 80s. It's gone down $100,000 two times. It's gone down 50 grand each over 6 weeks. So that house has gone from $699 to some $599. And she goes, I wanted to buy it at $550, but I think it's going to go a little bit further. So, and that's what we're starting to see, in some markets is the pricing, and that shows up in Zillow.
Right.
Yeah. Interesting.
Yeah. So does Zillow have a specific metric for that? Like cumulative total of like price drops or price rises once the property goes on?
Yeah.
In aggregate total,
Yeah, you can follow that address, and watch it. It's pretty interesting.
But do they combine it for the whole market? So to give an aggregate total of the net price increases or the net price decreases?
I haven't done that, but maybe.
Altos Research does that, though. Altos does that. So they look at percentage of price reductions, and they look at it in time.
For sale currently.
Yeah. So basically, they'll say like, how many people reduce their price within 1 month of listing, right?
But,
I was just interviewed on another podcast about that just like a few days ago. And I said, I don't really love that metric because I think and Kenny, you know this for sure, like all sellers are looking in the rear view mirror, right? They're all thinking whatever my neighbor's house sold for, mine's worth more. And they're looking at the past, and that's fine when the market's going up because they'll still be reasonable. But when the market's declining, that rear view mirror is a distortion. And so, it's sort of like their expectations are always up here and the reality is somewhere down here. So,
well, it's interesting because, Danielle's like all over this one house, right? So, and it's in a great spot. It's like McDonald and Scottsdale Road area. You guys know that area. So anyway, it was when they listed it 8 weeks ago, that was the market. It looked like, she's like, yeah, that's kind of what it was. Obviously they haven't had any buyers or, any solid offers, I would say. And so I think that's a result, George. The buyer is solving to their monthly payment, just like they do a car. So, that rate has gone up. So, whatever the mortgage was, call it, 4 months ago is significantly higher today. And so, but their wage growth hasn't really moved. So, they can afford less.
Right.
Yep.
So Jason, what's the 30-year fixed right now?
Well, for an investor, it's going to be a little higher, but you're looking right around 6-ish, little over 6, I think. Yeah.
Okay. So last time I checked on that, maybe 3 weeks ago, it was over 7.
Yeah. Well, no, it came down. The rates came down a bit. So you're, 6.2, I think you can do on a owner occupied. But the problem is that the expectations haven't adjusted yet. People's expectations, like Kenny says, they're solving for the payment, right? And their expectations are still what they were, 8 months ago, right? And they could just buy a lot more house for the monthly payment back then.
And George, on the commercial side, which is the area that I'm more focused on, hands down, 20% discounts. So, what was, let's say 50 grand is 40 grand, there's no question. This is a space, as you guys know, we made 50 offers this year. But there's hundreds behind that we didn't make offers on, that we ran the numbers on. So we're, the markets we're in, we're seeing cap rates go up, and everyone's solving the cash flow. So, if your cash flow was, obviously higher 6 months ago than it is today, and the only thing that changed is the cost of debt. So, so the buyer is going, shoot, like, I'm not cash flowing like I was because the cost of debt's higher. So I'm going to offer less. So that's starting to hit the commercial space right now. That's what we're seeing.
So,
Yeah.
Jason, do you want to take this question? I've
Yeah,
got
I do want to take that question, and I just pulled up the rates for you. I want to show you that too. But this is a good question from Harlan.
let's read it here
And
for the people so the
what's that?
listeners can hear it. So let's read it so the listeners can hear it.
Yeah. Jason, do you think South Florida prices are sustainable, new normal, or overvalued? I don't think they're sustainable. I think South Florida is an overvalued cyclical market. The problem, and Miami has historically been a very cyclical market. Miami and the surrounds, Fort Lauderdale, whatever, all the, South Florida, just south of where I live, is mostly considered South Florida. But the problem is now you have a different dynamic than the last cyclical cycle for that market. You have this mass migration to Florida because everybody loves our governor so much, and is leaving places like New York and the oppressive left-wing governments. So that's what is a little different this time.
But are you more inclined to look at North Florida, like Jacksonville and maybe Orlando, or is that kind of in the
Well,
same?
yeah, those are going to be much more linear. So that's
right.
a good point you're making. Yeah, exactly. So here's the rates, just so we don't forget to cover this. And I'll take this off here so you can see it. So this is bank rate, and here we're at 6.23% for a 30-year fixed rate loan today. The best offers, but the national average at 6.6. But top offers on bank rate are 6.23. Okay.
So what makes the bank rate go down when the Fed's rates are going up?
Well, because the 10-year, Kenny, the 10-year's going down.
There you go. Okay.
What have you guys seen as far as rent? Are you seeing that soften out a bit? Are you still seeing those just massive increases, decreases? What are you guys seeing on your end?
No, I'm not. Like I had a big company meeting. I had the entire company on a Zoom like 2 weeks ago, and I said, just fill up your occupancies. Don't worry about rent increases. Let's go into 2023 highly occupied. And people are already getting squeezed on affordability. We've had a great run. Knock it off. We're not trying to sell or exit these. So, let's just fill up. And, because people are, their affordability is killing people. So what I would say to that, George, is it's not negative. So there's not a lot of concessions or anything like that, but it's definitely significantly less than it has been, which is actually easy. My entire career, my underwriting was 2 to 3% rent growth my entire career, right? So I've had some anomalies in there, and this was certainly one of them the last 2 years.
But so Kenny, you're saying the last 2 years, zero rent growth? Or
last 2 years
high rent growth,
strong rent growth,
right? But now that has come to an end, right?
Yeah, well, at that pace and at that rate, yes.
Yeah. So what was last year and the year before? Are you talking 10% or what?
Well, we're in many different markets, but many markets were over 10. Some were 20, if you can believe that. So there was a time, it was nuts. There was a time, like, listen to this. We have a property in Peoria, Arizona, right where the Seattle Mariners play. And, I said, man, rents are going up crazy in this area, And so we looked at it, let's call it in the first quarter. And then I really didn't look at rents till about the third quarter. I like to look at them, but not, I'm not obsessed about it. So we were about $200 under market that quickly, just in the period of, 6 to 8 months. And I'm like, man, like, is the market really moved that much? Obviously you can't raise rents at that pace with people that are in leases, but what you do is you test them on the new people coming in. So we're not really jacking the people that are living with us. We're actually re-renting, any move outs at the higher rates. And so that's actually what we're focused on. That way we're not disrupting, existing tenants that have been with us for a period of time.
Yeah, makes sense.
That's interesting. When you go into a deal, do you base the amount you're willing to pay on current rent rolls, or do you use pro forma numbers?
So I never use pro formas. They're always all over the map. So I call it wholesale and retail. So, you're always trying to buy, and what you're trying to buy is the value in the rent roll, essentially, right? And
Right.
sellers trying to sell is the value in the rent roll. So that's part of the magic, but in addition to that, if you do have this, sometimes you'll find a 20, 30-year property that hasn't been touched in 20 plus years. So old appliances, old flooring, that kind of stuff.
Yeah.
So you can do that kind of stuff to what I call force equity too. So it's kind of you have to look at that, which is kind of to be determined. Then you have whatever's in the rent roll currently. But yeah, the seller is obviously always trying to sell for the future, and we're trying to buy the present.
Yeah, exactly. I mean, it's just like buying a business.
Yeah.
Exact same thing. Yeah. So this person brought up a question. I think it might be helpful. I can't click on it.
Yeah. Let me
answer your question a little bit. This person said, George, can you explain your answer to Kenny's question further? What makes mortgage rates go down? Yeah. So it's not just the 10-year. I just kind of just threw that out there because I thought we were moving on to a different topic. It's the 10-year to a certain degree, but then it's also going to be really the how should I say this? The risk premium, and that risk premium is going to include future inflation expectations. And one of the reasons you saw mortgage rates go up so significantly, in addition to the Fed raising rates and the 10-year going up, is because the Fed stopped buying mortgage-backed securities. So if the Fed isn't that buyer in the market, now all of a sudden, those new mortgages that are created are having to be absorbed by the private sector. And the private sector actually cares about a profit and loss. The Fed doesn't. They're an indiscriminate buyer. So since the private sector is concerned about a P&L, they will go ahead and attach a higher risk premium, most likely, than the Fed will, which is why you could see such a rapid acceleration in mortgage rates, maybe even above and beyond the rate of increase with the 10-year Treasury, because again, more of those mortgages are being absorbed by the private sector, where they are putting a risk premium on things like future inflation expectations.
Okay. All right. Let's get to some more of these. We got quite a few questions here, so let's just grab some more. Okay. Transactions have significantly slowed in recent times. Every year, usually 5 or 6 syndications exit. This year, I've had 1 exit. So this must be someone who is a syndicator like Kenny, right? Is that how you read that question or that comment, folks?
Yeah. So what's happening in our space is, the LPs, or the people that actually come into the deals, are slowing way down, being a little more cautious. They have a lot going on. They're questioning perhaps some operational issues from the last 2 or 3 years on a lot of these syndications. And they're taking a look at, like we had a couple of very smart investors ask us a question about, anything that we bought in the last couple of years around bridge loans, variable loans, because what you do in that scenario, I was explaining to George, you do a bridge loan and then you get that value add and then you put agency debt on it. So the bridge loan is short term, but it's also a floater. So what we did is, actually I should do a video of this. We actually did caps at the time when caps have gone up significantly. So it's expensive now to buy a cap on an interest rate, but we bought them on everything that we did. So we're actually getting checks, George. So it's gone so far that we're actually getting cash flow from our cap. Which has been very, very interesting. So to answer his question specifically, when you start to exit something, you have an exit cap rate. So the exit cap rate is everything. So let me just give you an example. If you said that you're going to increase your net operating income by 20%, let's say, based on whatever's going on the property, and cap rates go from 4 to 5, that 20% is gone, because the value went from 4 to 5 on the new NOI, but the cap rate on the new NOI is 5%. The cap rate on the old NOI was 4%. So you can do all this work and then have the property be worth the exact same amount, even though it's nicer, the rents are higher, all that stuff. But the exit cap rate is what's going to be very interesting to watch this year on a lot of these syndicators that, in my opinion, they have managed money, managed debt, managed equity. So, if George is, got $100 million fund and he entrusts me with it, he wants that money back, like he's going to say, hey, our deal was, I want it back in 2023. So a lot of these operators don't have a choice. They have to, they're going to have to exit, when the money wants their money back. And that exit cap rate is going to be an interesting scenario for next year.
Wow. I mean, I don't know how this works at all, Kenny, but is there a scenario where the fund manager just goes back to the investors and says, hey, I can give you your money back now, but if we do that, we're going to have to sell at a loss. And so, if you give me your money for another 2 years, then we might be in much better shape and you might not lose money. You might even make money.
Absolutely. Those conversations are going on. So you can imagine this, George. Let's say the money manager, let's say that you made a deal that you're going to do all this work in 2 years, and in the third year you're going to exit. So what happens is managed money, first you got your debt, then you got the managed money, then you have what's called the carried interest or the GP or whatever you want to call it, sweat equity. They're at the end. So what's going to happen potentially is a lot of these people that did all that work are not going to have that money, and the LPs, they're probably in pretty good position, I would guess, because they're above that. But those conversations are going on, and as you know, if I go to you, let's say I'm at 3 years, and I say, George, I need a fourth year, like rates are going down and whatever, and we're having this conversation, you got to decide whether you're going to allow that, number one. But also it lowers your return as your money's out longer, the IRR, internal rate of return goes down, as you know. Right. So those are all the backroom convos going on right now.
Yeah, this is really great, because when you look at just kind of the macro, you don't really appreciate the significance of the interest rate hikes we have had and the rate to which those rates have actually increased. This is, you can say, well, we had much higher rates in 81 or something like. Yeah, we did, but they didn't go up this fast.
Right.
I mean, they have just gone parabolic.
Oh,
and I don't know how far back you have to go to have rate increases happen this quickly. I don't know that right off the top of my head, but I think this may possibly, don't quote me on this, but this may actually be unprecedented.
Yeah, I think it is.
United States.
Yeah.
And so, again, from a macro standpoint, I find this interesting because you don't really think through the significance and how this plays out with real actors in the economy until you listen to what you guys are saying. And then you start to, the gravity of the situation starts to impact you quite a bit. You say, oh, okay, now I'm really getting it as to kind of the struggles. And, that's probably what the bond market's predicting, Kenny. That's exactly, it goes back to our bond market discussion. The bond market probably knows exactly what you're talking about. And they know that the interest rate hikes that happened 9 months ago is something that we're seeing right now. So the interest rate hikes that we have today are going to play out in 6 months or 9 months from now. And they're realizing what you're saying, hey, this is going to cause some big problems here. And
so you probably saw this week and last week that there's a call on the redemptions for Goldman and Blackstone and
BlackRock. Yeah. I wanted to get your opinion on that.
But those withdrawals are insane. I mean,
what that is, George, is that they're saying, listen, we don't, we see rising interest rates, we see rising cap rates, and when people invest, like, at that level, there's a very defined period, 1 year, 2 year, 3 year, very rarely over 3 years. And so, all of that is starting to play out, and on its simplest form on that, that 699 to 599, it's the exact same issue, right? Is the seller thought it was worth X, but the buyer doesn't. So now that's $100,000 haircut so far, with that one seller. And so if the money was raised in that scenario, which it isn't, of course, first the debt, then the LPs, then the carried interest. So that's how that works.
Wow. So Jason, what is your opinion on REITs right now? Is there, I mean,
well,
I don't really follow them. Is there opportunity there, or not really?
I'm no REIT expert. And REIT stands for Real Estate Investment Trust, but I'm not a fan either. But maybe I don't know enough to be a fan. but I can tell you, people are withdrawing their money from them, so it doesn't make me feel real positive. I don't know, Kenny, you'd know more than I do about that.
Yeah, well, it's the exact same issue, George. Let's say you were in one of these REITs. Doesn't really matter who. You're taking a look at it and you're going, oh my gosh, like rates are going up. It's going to affect cash flow. Cap rates are going up. I'm gonna exit now, and get whatever I can today. That is kind of the beauty of that. You can sell your shares at that point if it's not already baked in.
I wonder is there any systemic risk in that? I'm just trying to think how does that work, Kenny, when, like, as far as the structure, when they've got something like that where the underlying asset is illiquid, but the investors need liquidity.
Yeah. What happens is the bank gets paid first, debt. Typically these are levered. So, and then the LP gets whatever's left. And that might be, whatever it is, so, whatever the value sold at, the debt paid first, then the LP. So if the LPs are, let's say the debt's 50 and the LPs are 20 and the thing's at 60, the debt pays 50 and then the LPs get 10, they get 50 cents on the dollar, basically.
Right. But Kenny, but my question is, if the LPs want their money back, then Blackstone has to sell the asset, right? Or how do they get that?
What they do first is they limit withdrawals, and that's what they've done. They've cut it off.
Buy themselves time, or is that what that's all about?
There's essentially a run on the bank, and they said no more run. We're closing the bank. There's a bank holiday. You can't take your money out because we don't want to be liquidating any more assets.
But not on the non-traded REITs. So that's why you see that, right? So this is big money, right? So if somebody's giving that kind of money to BlackRock or Starwood, they're saying, listen, guys, like, we want it back, and obviously these are all legaled up, and there's agreements around all of this. So it's very interesting to see that article come out.
Yeah. Okay, let's get to a couple more questions here. So we've got, values, sales,
another
drop
thing
rates.
that I don't know if you guys want to talk about it, but if you want to, I can dive into it. Is the Fed is now losing so much money that the remittances to the Treasury are negative, so they're basically insolvent. I don't know if you want to. That's probably more of a macro discussion, but it is interesting that the Fed's basically technically insolvent right now.
Yeah. So what happens when the central bank becomes insolvent? Like, what is the end game there, George?
Oh, Jason, you'll love this. You'll love it. It's so what the Fed does is that when they when they have profit, then that's supposed to go to the Treasury as far as a remittance, right? So if they make profit, which they do from from the asset side of their balance sheet, then they pay the banksters who own the Fed a 6% dividend, and anything above and beyond that is supposed to go to the Treasury. Now, whether it does or not, I don't know, but let's just assume that it does. But when they take a loss, then the Treasury doesn't pay them back, right? Because the Treasury doesn't have any money. So what they do is they just fill the gap with something called a deferred asset, which is just absolute nonsense. What it is it's basically a piece of paper,
a deferred asset.
It's just a piece of paper that says we'll just use this as an asset on our balance sheet, and what it represents is future money that we will give to the Treasury at some point in time. So right now they've got $13 billion on their balance sheet as far as these deferred assets. So when they actually, assuming they go cash flow positive, then they're going to reduce that down before the Treasury gets another dollar of remittances. But it's just a complete accounting gimmick.
So it's an IOU.
Yeah. It's just like basically, Kenny. It's just like you having to, you sell a property at half of what you paid, so it blows a hole in your balance sheet, and you say, "Oh no, that's $50 million I lost." Oh no, I'm just listen. I'm just going to give myself an IOU. So the next time I make $50 million, then I'll just book that as profit right now, or I'll book that as a capital gain right now, instead of when I would have made it in the future, because of course I'm going to make that.
Financial engineering, man. It's ridiculous.
Yeah. It is just, the level of insanity when you,
and the level of insanity of financial engineering in the crypto market is just incomprehensible too. Hey, guys, I just want to take a minute. I know we'll talk more, but I just want to mention our upcoming event. Of course, that's kind of why we got on tonight, because we wanted to share this with people. And this is Empowered Investor Live. It's in Scottsdale, beautiful Scottsdale, Arizona, end of January. And we've got a special deal tonight. You can come and see all of these awesome speakers, two of which you've got right on here. You've also got Joe Brown with Heresy Financial, Sharon Lechter, Tom Wheelwright as well, and many other speakers. The VIP tickets are totally sold out, but general admission, here's the deal. Tonight, only by midnight, you get 2 for the price of 1. Okay, we offered that one other time before. So if you go to jasonhartman.com and you grab your tickets for Empowered Investor Live, you get 2 for the price of 1 on this general admission ticket. It's already $500 off the door price, but 2 for the price of 1 until midnight Pacific time. Okay, got it, everybody? Midnight Pacific.
And I see that includes Jason's air guitar contest.
And that's the best part.
The price of admission right there.
What we haven't figured out yet, and maybe people can comment below, what should the prizes be for the winners of the air guitar contest?
Right. Well,
what do you think?
I don't know. Probably a cassette tape to Quiet Riot or something.
Come on, feel the noise, girls rock your boys.
Or a record.
That's a great song, by the way. Yeah, good stuff. All right. So just wanted to put that in there. jasonhartman.com. Get your tickets for Empowered Investor Live. We'll look forward to seeing you there, folks. Okay, so we got small houses in Santa Cruz. Some of these I'm just popping up there. They're not really questions. They're more comments. But yeah, and Phoenix has gone crazy, and now it's going the other way a little bit. George, you want to grab this one?
Well, let's see. Banks buy the debt at 3% and sell it at 7%. The Fed rate is what the banks buy at. So I'm not sure what they're talking about as far as buy and sell.
Just the bank's margin, maybe? Nothing too big.
Maybe that's what they're referring to, the nominal rate. Yeah, maybe what they're talking about is the difference between IOR and what they're what they're paying on deposits and what they're getting on the lending. That's usually the way it works, but now it's so screwy with all the reserves in the system and the IOR payments that it's tough to tell. But that is an example of, when the Fed, so how do they have this negative equity that we were talking about? It's because they bought all of these bonds, mortgage-backed securities, treasuries at a very, very low interest rate. And because they're doing quantitative tightening, they're having to sell some of those bonds at a much higher interest rate, therefore a much lower price.
Yeah.
And you combine this with them paying interest on reserves, which they didn't do. Remember, prior to 2008, they didn't pay interest on reserves. So if you think about that, it's interesting because they've got, call it 3.5 trillion on their balance sheet that are in the form of bank reserves that the Fed has to pay interest on. Right? So where do they get that money? They have to just print it out of thin air. But if they give, let's say, a 4.5% rate on 3.5 trillion, that's a significant number. So what happens is that increases the liability side of their balance sheet, while at the same time, the asset side of their balance sheet is taking a hit because they're doing QT and they're having to sell these things at a cheaper price, and just exacerbates that problem of, well, what would be a problem of negative equity if they didn't have that deferred asset.
Yeah, right. Everything in this system has to someday be repaid. You know, the chickens come home to roost, right? I mean, everything in this house of cards system they've created someone has to do work to pay for things. That's
but I think we've already paid for it. We actually pay for it in real time. I think that when you say chickens come home to roost, that implies that we're going to have to pay for it some later date. But I do think that we're paying for it in real time from a standpoint of going back to our original conversation with the real GDP going down because of the inefficiencies in the economy, whether that's due to regulation, whether that's due to no more price signal, you know, because the Fed's trying to micromanage the price of money. That all leads to lower real GDP growth, which, as we can tell, that obviously reduces the per capita standard of living in and of itself. And that's not even including the rate of inflation and how that destroys the poor and middle class.
And the reason people don't notice that or value that concept, you're pointing out something very important, is that, what I always say, you can't hear the dogs that don't bark.
Exactly.
These dogs aren't barking because no one really can imagine or fathom how much better life should be if it wasn't for this financialization, this financial engineering, and the elites skimming all the money off the top. I mean, think about it. We've got this incredible technology. We should be living incredible lives. And modern life, we're all working harder than ever. In the 70s, the predictions were everybody would only work 3 days a week because there wouldn't be anything to do.
But we can quantify that, Jason. We can quantify it.
How?
Like everyone on this live stream right now, or not everyone, but most of the people on this live stream have experienced life from, let's say, 1990 to 2020. And we do see increases in the standard of living to a certain degree. But just keep in mind that real GDP growth, which I think is a rough proxy for the standard of living increasing, right? Because increased economic output has been 94%, which sounds great. Oh my gosh, 94%. And go back to the late 1800s, that same 30-year time frame increased by 300%. 300. Just think what life would be today in the United States if we had a 300% increase in real GDP from 1990 to 2020. That is, people can't even fathom what the differences would be for the average Joe and Jane.
I know you're not a fan, unless you've changed your mind, but the book that just illustrates this so well is, and it has nothing to do with the title, The Bitcoin Standard. That book, he just lays out that case of how much more progress we used to have and how inventive that period in the late 1800s was. And all of the incredible things that happened, and how that really, like, all of this stuff kind of ended with the 60s. That was a great time. The lasers really came about, the space program. I mean, we think we're inventing all this stuff now. All we're really doing is using software to push data around, which is cool, no question. But it's not like we're really creating a lot nowadays. Right. I mean, when's the last time we built a Golden Gate Bridge? When's the last time we, went to the moon? Right?
But the problem there is that the solution, I believe, maybe I'm wrong, offered in the book is, well, we just got to go into a fixed money supply. Sound money solved that problem. And what I proved at the beginning of this is not just sound money. It's a lot more to it than just sound money. You have to look at government spending as a percent of GDP, and sound money doesn't necessarily address that problem.
Yeah. Fair enough. I just like the book. It lays out a lot of good things. It's a really good economics primer. It's good. Okay, you want to jump into some of these things? So I would say short New York City and New Jersey. What would you guys say? Yes, you agree?
Yeah, I don't know how to do it though. How can I? I don't know. I don't know how you short a city other than just move. I don't know.
Yeah, just move. Okay, so Kenny, this one's for you. And sorry, we can't be seen here. I don't know how to rearrange the screen to. No, that doesn't do it. What do we do here to not cover Kenny's face?
Oh, here, I can.
Sorry, Kenny.
So this is about rent. So do I think rents will start to come down? So rents are going to come. I personally think when the interest rates go up on single family homes, that forces more people into the rental market. However, where rents will start to come down are where, I always tell people, like, real estate exists for people, period. So no people, real estate issues. So, so you got to really look at migration patterns. So in the Midwest markets, you have an influx in or influx out based on the existing supply. That is actually the bigger issue. So as an example, areas like Florida, you have massive rent growth. That is because before that, you have existing amount of properties there and all these people going. Same thing with North Carolina, same thing with Texas, same thing with Arizona. So that is a huge factor. It's the same reason you can't get a dinner reservation, in some of these markets, because there's the amount of people are just stressing out, all the services and stuff, including rentals. So that's actually the bigger issue.
Yep, I agree, Kenny. Very well put. Okay, so this goes back to the earlier concept. Oh, I think we had covered that one already. Okay, so let's see. Can really blow the investment. Okay, $40 trillion due in 2023. I don't think the number's quite that high, is it, George?
Is that the 40 trillion doing? I don't know about. They maybe talked about the Eurodollar market when you're talking about numbers that high.
Yeah. Okay. What's the deals? Most of the deals that come across my desk are purchasing at a cap rate, I'd say 150 basis points. But the funny thing this year is interest rates already floated to the max cap. Kenny, you want to comment on that one at all?
Yeah, so that's exactly what I was talking about. When we bought rate caps, it floated to the max cap, and then that's the hedge part, and then you get paid now for having that rate cap in place. So the one thing is rate caps. I was told the other day have gone up 10x. So the price of a rate cap has gone up a lot.
Yeah. Okay, this is a good question, a general one. How to get a good mentor? All of us here, follow our work and our YouTube channels and podcasts and so forth, and go to conferences if you want to meet people in person, of course, like Empowered Investor Live or Kenny's conference coming up. It's after mine, we've got George's conference, Rebel Capitalist Live, which is May, right, George? Orlando?
Yeah, May 12th to the 14th.
In Orlando. And then Kenny, yours is back in Scottsdale at the Westin in June, right?
Yeah, actually the Desert Ridge Marriott and this year, and in Scottsdale it's June 15th, 16th, and 17th. Yeah, called Limitless.
Excellent. Yeah, so you got 3 great conferences right here that you can come to, Tim, and you can meet all kinds of mentors. Good stuff. Okay, let's see what else we got here. Pension money. Yeah, boy, there's a pension crisis going on, folks, and that one isn't talked about nearly enough.
Other than there isn't any money left, right?
Yeah.
That's actually happening a lot. Kiyosaki wrote a great book a couple of years ago called, Who Stole My Pension? And it was way ahead of its time. It's starting to show up.
Yeah, that was.
It is, really the prophecy book way back when, right, Kenny?
Yeah. Oh, yeah. That one too. Yeah. Robert, like us, we're all, trying to figure out, what's going to happen next. Like everyone probably on this call, and Robert, he's a madman, the amount of books he reads, the stuff he watches. And I'll get texts. I'm sure you do too, Georgia. I'll get videos and books sent to me like at 2 a.m., 4 a.m. He'll start blowing me up at 5:36 in the morning. You
Yeah.
know, did you watch that video? Robert, I haven't got up yet. But the guy, the one thing to say about Robert, he is a student of life, man.
Oh my gosh, just a voracious, yeah.
Definitely good. Okay. All right. And thank you for the comment, the compliment there, Wondering Doc. Okay. So here's the private REITs. Yeah, the REIT stuff is huge. I don't know. You see any particular questions you want to grab here? Anybody?
I
Oh,
actually
here-
don't know the answer to that one. I think it all has to do with whatever agreements were when you put the money in, you know.
Yeah.
So
And here, another super chat: stack cash or buy equities over the next 6 to 12 months. What do you think? Buy more equity in things, or keep it in cash, guys?
in
I mean,
what?
I'm personally just buying T-bills.
Yeah.
Like right now, the model portfolio I have for Rebel Capitalist Pro is 10% gold and 90% T-bills.
Wow, that's a lot of T-bills. And are you getting those 8% T-bills? Those what do they call
I-bonds,
them?
no.
Yeah, I-bonds. Yeah.
No. Just 3 month, 6 month T-bills at I don't know what my average yield is. Let's just call it 3.5%. It's because I want to buy commodities long term. So I just wait for the price to come down. I figure the price comes down, the interest rate will come down as well, and I'll get a capital gain on the T-bills, and just parlay that into a longer term hold on commodities.
What kind of commodities?
Like a lot of them. I mean, I like copper, I like nickel, I like oil at the right price, I like coal, I like lead. You know what's interesting is I just did a story on this the other day that 2022 is projected to be the highest usage of coal in history.
Wow.
So what I kind of, Jason, you'll appreciate this because it was kind of snarky. So I took that that headline from CNBC and I tweeted that, and at the top I said, "Take that, Putin," because basically the reason is because all these sanctions against Putin from all these people who are, you know, climate change activists,
Oh, they're nuts.
and they're also pushing back with, you know, we got to do something, we got to sanction Putin. Well, okay, you got your sanctions, and now the world is using more coal than it ever has.
Yeah, that's just silly. I mean, this climate stuff is just a disaster. Okay, oh, this is an interesting statement. Inflation is just an insurance payment for future opportunity. Inflation is just, I think it's against future opportunity, right? Is that what you mean?
Yeah, inflation is an insurance payment. It's definitely a payment because it's decreasing your purchasing power for future opportunity. I don't know how they're making the connection there between
well,
future
you're kind of,
opportunity and
if you
inflation.
paid a big insurance premium, you have less money to spend, maybe.
The only way that I can maybe translate that is if you're talking about inflation strictly in terms of increase in money supply growth, you could argue that a productive increase in money supply growth, like we saw at the end of the 1800s, would result in additional goods and services being produced by the economy and greater economic output in real terms, which would provide opportunity in the future. That's the only way I can connect those dots.
I'll tell you, this right on the screen, this is who taught me about inflation as a kid. Wimpy from Popeye. I'll gladly pay you Tuesday for a hamburger today. That's
good point.
That was my first teacher on inflation.
That's funny.
And hit the like button. Thank you, StarPath, for rallying the crowd. We got way more people watching than have hit the like button. So, like Graham says, smash the like button. Okay. What do I got? Dang, got to check out my schedule. Yes, you got to come to our event, Wondering Doc. Okay. So, George Jason, do you still recommend buying homes in red states? One multi $700,000 fixer upper takes 3 to 6 months. Blue state, 4 months. Yeah, well, it's a lot easier to fix them up in conservative states, that's for sure, where you don't have to do 36 environmental impact reports. Kenny, you got to experience that as a builder. I mean, are you doing any business in left wing states?
No, we used to do stuff in Oregon, and you know, that was then. This is now. You know, so
Good decision.
yeah. Like it's funny. I was on a call with the head of capital markets for Arcadia. You know, which is, you know, he out of San Francisco. He basically decides where the money goes, and so I'm like, you know, what are you seeing? And he goes, I'm staying away from the coasts, except for Florida.
Yeah.
And, you know, and so, you know, I said, that's interesting. He goes, well, money goes where it's treated best.
That's right.
Yep.
And, you know, it always will. So as these, you know, regulations get passed and they make it harder and harder and harder, you know, when you cap income and then grow your property taxes, you know, I don't know who's going to want to invest in that market. You know, I had a friend that invests in Oregon. He's from there, and he's like, man, you know, I can't raise my rent, and they're jacking my property taxes. And I'm like, dude, I wish I had a solution for you, but that's, you know, it's a great example. I mean, that's a real example.
The solution is hit the bid.
Yeah.
Yeah.
That's a good point.
Pull the ripcord on that one.
That's actually what I told him. I said, I don't think it's going to get any better, man. You know.
Well, and the thing you didn't mention, Kenny, is that some of those places probably got vandalized during the BLM riots.
Oh, so you love this. So I did
mostly peaceful ones.
The Chaz zone. Or no, that was
I did a condo project in Oregon. This is actually kind of funny. And I you know, we sold it out 300 units or whatever. And I always keep the models. So I buy the models, and Ross had a model and I had a model. So I said, I saw this happening, you know, I'm like, shit, I'm going to get out of this thing now. Right. So Ross waited about a year. So I guess my partner had it, you know, this is like a $400,000 condo that he's owned for however long, 15 years. And so I said, you know, is it sold yet? He goes, no. I go, why? He goes, well, it could be the riots. It could be the crime. It could be the homelessness, or it might be the price.
He didn't mention the regulations, though.
Yeah.
Take your pick.
I'm like, wow, you know, because it's right on the river, downtown, beautiful, has views of the Willamette River, and you know, this was drop dead gorgeous. We used to,
Yeah.
you know, take a train there and then go walk around and go to these great restaurants and stuff. And you know, it's changed a lot. Let's put it that way.
Isn't that awful, you guys? Some of these areas, they've been. One of my friends wanted to create a charity called Operation Rescue or something like that would basically rescue people that are older people that live in these homes that used to be in nice areas that now have become all blighted because of left-wing politics. You know, they've ruined these areas.
My brother worked for Seattle Police. By the way, I'm from Seattle, so
yeah.
I go, how's it going up there with this Chaz thing? He goes, well, you know, when you hit 911 and, you know, they all go together, like cops, you know, ambulance and fire, you know, you don't just get one. He goes, they defunded the police, so they won't go. So now, you know, they're just, you know, they won't even go in. And so, you know, those are all the stories that you saw. So they screwed themselves by doing that. And then the police said, screw that, you know, because we're not going to go. So basically the 911 calls weren't going in.
And I grew up in Portland. I grew up there.
Yeah.
I remember what it was like in the 70s and 80s and 90s, and it was a very, very pleasant place back then.
The Rose Parade downtown.
Oh my gosh!
The McCall Park. It's flipping beautiful.
Yep.
That city is gorgeous.
Yeah.
Do you know what I always say, guys? I always say the peak of civilization was 1990. That was the peak. Everything's gone downhill since then because the music changed, the culture changed. And it's just a whole different world now. So yeah, I don't know. You agree with me, or you think I'm crazy?
Well, I'll tell you what. I just got back from Thailand, Indonesia, Dubai, and Singapore, and we were in Doha. So you can imagine, like, you're just sitting there going, the transportation, the buildings, you know, the safety.
That's great.
Like when you see that perspective, maybe not necessarily in Bali where we were or Bangkok.
No,
you know,
Singapore's.
But Singapore, Doha, and Dubai, you know, like it has everything you need. It's, you know, what Dubai's like 40 years old, right? It's flipping gorgeous.
Yeah.
And so, you know, we're getting, people are rolling right by pretty quickly.
Did you stay at the Marina Bay Sands?
I didn't. We couldn't get in. I waited too long, but I did eat. I did go there and eat dinner. So we didn't
did
get
you?
all it.
Yeah, I've stayed there quite a bit. I
I,
really enjoyed myself there.
I stayed there last time I was in Singapore, and to give you an example of the cultural decay, there was this one girl at the pool with a selfie stick taking pictures of herself for it must have been 4 hours. I kid you not. She stood there in her bikini taking pictures of herself at that pool for 4 hours. It's incredible. Yeah, it's crazy, the culture. Hey, George, there's one more question I think for you here that's probably one to get to, and then we'll wrap it up here, guys. So,
yeah, I mean, I can see I can see countries like Russia and maybe China potentially settling in rubles, or maybe Russia, India settling in rubles. But to think that there would be like a global standard where like the petrodollar, where everything, all transactions between all countries that are commodity based are denominated in rubles, that's very, 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 very unlikely.
Yeah, I would agree with that. Yeah, it's not gonna happen anytime soon. Well, guys, why don't you wrap it up with some words of wisdom? We, all, a lot of you joined late, I noticed, because the numbers of people here are now much higher than they were earlier. So feel free to go back and watch the beginning of this. We really appreciate it. Appreciate your likes. But Kenny, what are your thoughts for wrapping up this year and then moving on into next year?
Sure. Well, for anybody who's been in the market for, say, 10 plus years, they haven't really seen a downturn. But I will tell you this: there's a lot more money to be made in the next few years with this downturn. There's no question. You might not see it today, and I understand that. But most of my wealth was, I've been, like all of you, been active, but most of it was in buying the 8, 9, 10, 11. During that time, I still own most of those properties, and so I just want everybody to know, like, that you learn a lot when things unravel. You don't learn much when they're going up. In fact, you think you're the reason. So just keep that in mind, and stay positive and stay open-minded, and you'll see.
Yeah, don't confuse brains for a bull market.
Yeah.
Or I like to say, George, everybody's a genius in a bull market.
Yeah.
Even Sam Bankman-Fried.
Yeah.
Yeah. What are your thoughts?
Well, if I was trying to figure out and kind of predict what might happen, I would just stay really hyper focused on the yield curve. Historically, that's had a lot of predictive power. And I would just really pay attention to the 2-year. I don't think we're going to get higher than the high water mark that we set, what was it, a couple months ago at 4.7 or 4.74. And the reason that's important is because that's usually the max the Fed will take the Fed funds before they pivot or pause. So my point there is, let's just say in the next couple months that the 2-year went back up to 5%. Then you could say, okay, that's a brand new high water mark. And therefore, the Fed may raise rates even more before they start that pause. So I just pay really close attention to the 2-year, pay attention to the 10-year, see what it's doing when the Fed talks hawkish or when the Fed talks maybe more dovish. Just keep in mind that the next Fed meeting is the beginning of February. So we've got a little time here to digest current rates at, call it 4.25. And I think that's just what my best advice would be. Just really start to pay attention to the bond market.
Good stuff. Thank you for that, George. And I will just show the screen one more time here. Go to jasonhartman.com, get your tickets, and join us all for Empowered Investor Live, end of January in Scottsdale. It's going to be a great time. And of course, the air guitar contest is going to be one of the best parts. But you've got the 2-for-1 deal on the tickets to tonight at midnight Pacific time. So hurry up and go grab those tickets. And I like this graphic. I pulled out this really old graphic, guys. I think you'll appreciate this. when we were in California and basically marketing to California homeowners to say, do something with your equity, we made this little graphic: turn your castle into a kingdom. And a lot of people did this. We helped, a couple thousand people do this. They made fortunes buying properties in these other markets with their home equity. So that was a very good plan. But yeah, join us. We'd love to see you all live. Come and meet us, and it'll just be a really fun time. And we'll look forward to it. And then my closing thoughts are, I interviewed Rick Sharga. He's been on my show several times. He's with Adam Data. He was on my show yesterday. I didn't publish that one yet, but that was like the third time. And we went all through the foreclosure data, what little data there is. Foreclosures are running at about half the normal rate now. And you got to dice that up, because those foreclosures are entering foreclosure, but very few of them are actually finishing foreclosure. And all of this data that we're constantly talking about just leads us to believe that the housing crash narrative is just not happening. Okay. There is a bit of a slowdown. No one would deny that. There's definitely some serious price reductions in cyclical markets, but in these good, solid linear markets with, good bread and butter entry-level rental properties, those are doing pretty darn well.
Yeah,
and
just remember, the price can always crash up.
Yeah, it can crash up. Tell us, what do you mean by that, George?
It can go down in real terms.
Yeah.
So
Okay.
you can have
Yeah,
nominal price increases, but if it doesn't exceed the rate of inflation, then the real the inflation adjusted price goes down.
Yeah, absolutely. So inflation adjusted, but remember, the game of investing is about yield. It's about cash flow. That's what investing is.
Agreed.
Speculation is about playing the price game and trying to time the market, which is generally a fool's errand. So anyway, good stuff. Well, guys, thank you so much for joining me tonight here. I really appreciate it. And thanks to all of you who joined us. We really appreciate having you. I want to wish everybody very happy holidays, a Merry Christmas, and we will look forward to seeing you soon. And by the way, I should mention the collective mastermind that Ken and George and I own together. Our next event for the collective is in Jekyll Island, Georgia in February. And that is the birthplace of the Federal Reserve. So that's going to be a super, it's a beautiful.
You're not going to want to miss that.
I mean, I'm definitely going to wear my hat.
Yeah,
George has brought an all-star cast to that thing. It's going to be fascinating.
Hashtag end the Fed. Absolutely. Yeah, no, that's going to be great. And Kenny, like you said to me before, our meeting is actually in the Federal Reserve room, literally the room where they created the creature from Jekyll Island over 100 years ago.
It's gonna be awesome. All the members are very excited, and I think everyone's signed up already, even early, which is great. So we're gonna be talking about that at your event, Jason, the collective. So I'm excited. Anybody's interested in that, we can chat about it. But it's basically access a one-on-one to us.
Yeah. And that's a high-level mastermind. We do incredible trips and retreats that are just off the charts, luxurious, super nice stuff. And you get to hang out with Ken and George and I for 4 times a year. So good stuff. All right. Hey, let's wrap it up. Thank you guys very much. Happy holidays to everybody. Thanks for joining us.
Happy holidays.
Yeah.
Cheers.
Bye.